Welcome back to International Finance. We're going through Chapter 11. It's taking more time because I'm talking more about the fundamental stories about the bank regulations and then the buffer capital, camels analysis kind of things. But let's go through, okay? It has a lot to do with your international banking career as well. So let's go. International money market is the next thing, right? The euro currency is a time deposit in an international bank located in a country different than the country that issued the currency. So, for example, euro dollars are US dollar denominated time deposit in banks located abroad other than United States. So, US dollar time deposit. If my US dollar account over here gives me some interest to me, right, time deposit in Uri Bank, that could be a euro dollars, right? Euro dollars, US dollars deposited in European banks, giving me some interest to me. Right? That could be a euro dollar account, right? And then euro yen are yen denominated time deposit in banks located outside of Japan. Euro, yuan, euro, won, and euro can happen, right? The foreign banks does not have to be located in Europe. The important thing is, even though we name it euro, it does not necessarily mean that the bank has to be located inside eurozone. Then you may question, why do you use euro? But there is a historical reason, okay? If you look at the textbook, right, it has to do with the communist world countries setting up their account in French bank, right? Setting up a dollar account, right? They must have had communist bloc countries. They had to transact a lot internationally, and then they had to inevitably transact in terms of US dollars, okay? Let's say Poland or Hungary, they were working and transacting in US dollars for whatever reason it may be, because maybe they had to buy and sell oils or golds or their goods in other countries, but they want to keep their money in this US dollar in French bank, okay? French bank. Why not US dollars in the US bank? Because they were afraid that what if US government says, let's freeze this account of communist bloc countries, of Hungary, I'm going to freeze that. You cannot move it. And then they will be screwed. They were afraid. So that they said, they set up the US dollar account in French bank and say their name is like Euro. The code work like that, okay, in transactions. So that's why it says euro dollars. The most euro currency transactions are interbank transactions in the amount of $1 million and up. All right, did I say my bank giving me some time deposit interest? Sorry about that, not as much. Has to be more than $1 million, right? Common reference rates would be LIBOR, London Interbank Offer Rate, or PIBOR or SIBOR, Paris Interbank Offer Rate, or Singapore Interbank Offer Rate, like that. New reference rate for the new euro currency, well, Euribor is there, right? IBOR. The rate at which the interbank time deposit of euro are offered by one prime bank to another. Now, euro credits, right? This is a short to medium term loans of euro currency. Loans are denominated in currencies other than the home currency of the euro bank. Often the loans are too large for one bank to underwrite. A number of banks form a syndicate to share the risk of the loan. Okay? Syndicate, a group of banks getting together. Syndicate, we call it syndicate. Syndicated loan kind of things, share the risk of the loan, right? Syndicated loans, 채권단, right? 채권단, they say in Korean terminology. Syndication loan is the thing that we are talking about, right? So denominated in currencies other than the home currency in the Eurobank. Euro credits feature are adjustable rates. So on Euro credits originating in London, the base rate is LIBOR. So syndicated loans, they always price it as price the loan as LIBOR plus whatever basis points. Okay, LIBOR plus. So basis rate. Okay. So let's go through an example over here. You remember this euro lending and borrowing in the syndication market, right? We are using LIBOR rate. Regardless of whether you borrow it US dollar terms or euro terms or Japanese yen, whatever, it doesn't matter, right? In this market, right, euro currency, the benchmark rate is the floating rate of LIBOR, SIBOR, it could be whatever. But here in the example, it's going to be LIBOR. And then Teltrex, a company, right, can borrow $3 million at LIBOR plus a lending margin of 75 basis points per annum, or 75 bips or BPs, right? 0.01 percentage point is called a basis point or bips or BP, whatever you want to tell, right? On a 3 months rollover basis from Barclays in London. Rollover basis, what do you mean? Well, we know that LIBOR rate is fluctuating every day, day by day. Okay, we're going to see that, how it is made, right? But over the next 3 months, let's fix one LIBOR rate to be applied to this loan contract. And then after 3 months, we adjust the LIBOR rate. At that point of time, the LIBOR rate changes. Whatever rate it may be, we're going to follow that and fix it for the next following 3 months, right? So that's the idea. LIBOR rate, base rate changes 3 months frequency. Okay, 2 intervals. And then upon that LIBOR rate, we're going to add 75 basis points. That's the idea in each different time point. Suppose that 3 months LIBOR is currently 5.53 percentage point. Further, suppose that over the second 3 months interval, LIBOR falls to 5.12 percentage point. How much will Teltrex pay in interest to Barclays over the 6 month period for the euro dollar loans? So that's the question here. Is the answer. Now, LIBOR rate 5.53 percentage point. That's this guy. And then spread of 75 basis points. And then over the next 3 months, remember this is per annum, okay? Yearly rate. And then we have to divide it by the 4, which is like a quarter of a year. And roll over, which means the next interval, right? 3 months LIBOR, at that point, 5.12 percentage point, and then spread of 75 basis points. So we add these things. If you do the math, you will realize, and then we multiply it by 3 million, by the way, so that the answer will be $91,125, right? Now, that's one example using this LIBOR based computation of lending and borrowing. The thing is, right, you will realize that different maturities and different floating rates will create some interest rate risk, right? Banking is called asset liability management, ALM business, right? ALM gets back to your balance sheet, asset, right? Asset liability management. Of course, there's equity, but let's forget about it for now, okay? The thing is, issue is the market value of asset, right? And versus market value of these liabilities. They have to match, okay? They have to match, so that you would not have to worry about this buffer capital, okay? The asset value and liability value. It's sensitive, okay? With respect to, sensitive to the interest rate in the market. And then the different maturities. If you learned the investment class, right? If you've taken the investment class, if you learned about bond valuation or valuing the bond, fixed income, right? You will realize that the value of the bond is sensitive to the market interest rate movement, right? You learned about the convexity and kind of things like that, right? Value of the bond sensitively move to this, the duration and convexity, right? First derivative is duration, second derivative is convexity. Now, this asset value and liability value on the bank's balance sheet will be both sensitively moving together, moving to the interest rate movement. The trouble point is the sensitivity of this asset may be different from the sensitivity of these liabilities, right? Why don't they move together, right? If they're moving into different direction, you may be squeezed in the meantime, right? This way or that way. So maturity mismatch between deposit and loan can create a trouble, okay? Right, and then the duration problem, duration mismatch could be a serious problem. Still, the interest rate changes in the meantime, right? So big T is a maturity. So deposit side versus loan side. Let's say in the first case, let's say the maturity of deposit is longer than your loan side, the loan side, right? That means your time deposit finishes faster than the loan that you gave to corporate borrowers or something. So, and then in that case, let's say the market interest rate falls. Market interest rate falls, then soon what's going to happen? Well, your loan, right? Loan rate, okay? This one matures sooner so that you will replace with a new loan at the lower interest rate. New loans rate will be lower, whereas your deposit rate is fixed. Then the spread between these two, okay, will shrink down, right? Remember, the commercial banking business is about this spread management, right? Your income comes from this spread between this loan rate versus deposit rate, okay? It goes down, which means you'll be in trouble, okay? On the other hand, right, let's say your deposit, okay, matures sooner than your loans, right? So your deposit rate will be adjusted, okay? And then soon, then the interest rate rises. Then you will be in trouble because your loan rate is fixed, whereas your new deposit rate will be higher, so that your spread will again go down. You'll be in trouble. So how could you manage this kind of risk? Okay, there we need some forward rate arrangements, forward contracts to save your day. Okay, that's the idea. Move down to the next slide. Forward rate, an interbank contract, okay, that involves two parties, a buyer and seller. You want to manage your interest rate risk by hedging it using forward rate. The buyer agrees to pay the seller the increased interest cost on a notional amount if interest rates fall below an agreed rate. And then the seller agrees to pay the buyer the increased interest cost if interest rates increase above the agreed rate. Okay, that's the idea. So forward rate agreements can be used to hedge assets that a bank currently owns against interest rate risk. For example, a bank that has made a 3-month euro-dollar loan against an offsetting 6-month euro-dollar deposit could protect itself by selling a 3 against the 6 forward rate agreement, okay, and speculate on the future course of interest rates, okay. So here's an example. A 3 against 9 FRA is a 3-month forward contract on a 6-month interest rate for a 6-month period beginning 3 months from now. So here's the time interval from 0 to 9 months, and then initial 3 months, right? And then the subsequent 6 months. FRA period starts from 3 months from now until it finishes until 6 months from then on, which is 9 months from now. So agreement period is 3 months, okay, and then cash settlements happens at the end of 3rd month, right? Now, yeah. So at the end of the agreement period, right? The loser pays the winner an amount equal to the present value of the difference between the settlement rate, SR, and the agreement rate, AR. Agreement rate sized according to the length of the agreement period and the notional amount. So notional amount, notional amount. So the computation will work like a notional amount times settlement rate minus agreement rate, okay, times the periods, right, which is the number of days over 360 convention in this bond market, right? So that's the numerator, and you get the present value of it, right? That's why we divide this guy by 1 plus this interest rate applied to this period, right? The days involved. All right, so here is an example of forward rate agreement. Here, a 5 million euro, a 4%, 3 against 9 FRA entered into January 1st of 2018. Here's the following terms. You see the payment point over here, March 1st of 2018, and from then on to September, 6 months, which has now 184 days, right? On March 1st, if the actual rate, okay, settlement rate is 4%, nothing, no payments, right? You're good, 0. But if on March 1st, 2018, the settlement rate is 5%, okay, actual rate, settlement rate is 5%, the seller pays the buyer 24,918.74 euros, right? Based on the computation, the formula over here. The days 148, and the notional amount 3 million, 5%, and then 4%. If you do that, right, and then do the math, and you will realize it's this number. What about if the settlement rate is below 3%? Well, it's going to be 25,169.62 euros if you do the math. You stick it in the 3% rate over here. Okay? The buyer this time, by the way, pays the seller, right? Pays the seller the opposite direction, right? So will happen. Yeah, you remember over here is the seller pays the buyer, right? So that's that. So the next one is a proof of FRA utility, but we're going to go through that in the next set of videos. Thank you.